All right, here's the balance sheet. This is a classified balance sheet. But first, before going through the classified balance sheet, I want to point out that notice this is at a point in time. Remember, the balance sheet tells you what a company has, and in this case, at December 28, 2012, it tells you what the company has in resources, and it tells you who has claims to those resources. It's the creditors, I should point to all of this, and the shareholders, the owners. And as you know, then it's the total assets have to equal your liabilities, which is the sum of these two, plus your equity. Now, let's talk about the classified. Classified balance sheets, it doesn't mean top secret, it just means that the assets are split between current, meaning these are the assets that are going to be turned into cash or used up within the year. So let's say you don't know what a particular line item is. Just knowing that it's a current asset actually it can help you to get a general understanding of what the item is without knowing specifically. So we know that this is something that's going to turn into cash or get used up within the year. You've got your long-term assets. Those are going to be providing benefit for more than just a year, for years to come. Current liabilities, or your total liabilities, is split between what's coming due within the year versus what isn't coming due within the year. And then this is your equity, and all these balances right here were the ending balances on your statement of shareholders' equity or stockholders' equity. Let's go look at some of the measurements or ratios people will use to analyze a company. A very important one is the current ratio. It basically is going to tell you whether the company has the ability to pay its bills when they come due. So they call that a measure of short-term liquidity. When you calculate it, you take the current assets, not total assets, current assets, divide it by your current liabilities. And American Eagle has $3.18 for every dollar that's coming due within the year. So it's in good shape. But as far as being able to make sense of any of these ratios we've gone over, it's important to compare it to industry averages, which you can obtain via the internet, and you also want to compare it to prior years. The debt ratio, that's going to measure the company's leverage. So you have all these assets, the resources. They were financed by creditors, and the rest is financed by owners. The amount that's financed by creditors is actually riskier because if a company is faced with an economic downturn or has some issues, it has a legal obligation to pay back its debts when they come due, and along with the interest. So you'll see a lot of companies that ended up going bankrupt because they weren't able to weather the storm, so to speak, and that they had debts coming due but didn't have the ability to pay. So the debt ratio is a measure of leverage, and you don't want too high of liabilities or too large of an amount. Equity money, you don't have any legal obligation to your owners. You aren't legally obligated to pay a dividend each year. You're not legally obligated to be certain that the stock price goes up. So it's less risky to have equity money or shareholders' equity money than creditors' money. So American Eagle, the way you look at this is it has a debt ratio of 27 cents or percent, meaning for every dollar of assets, 27 cents came from the creditors, the rest came from owners. So this is actually not a very risky company. It has low leverage. Now you'll learn, if you take a finance class, or look into finance more closely, the cost of creditors' money. What's nice about it is that it's nice to be able to use somebody else's money to make money. So having too low of a liability might mean you're not taking advantage of other people's money. The last one here is return on assets. It's basically, you've got all these resources. Net income is a way of measuring how well did the company use those resources. So your return on assets tells the productivity of the company. So you take your net income in the numerator, and just like with the return on equity, instead of just taking the ending balance, you take the beginning and ending because you had somewhere between that amount during the year. So by averaging it, you get a better measure. So when you get that average and divide it into your net income, it comes out to be approximately 8%. The way you interpret that is for every dollar the company has in resources, it was able to make 8 cents during the year. Again, compare it to prior years and industry averages to see how well the company's doing.